broadly, there's public investments and there's private, right? So public investments, I think perhaps many of the audiences may be very familiar with, whether in India, US, Singapore, Hong Kong, you have public stock markets and you can buy equity, direct stocks, mutual funds, bonds. There are various instruments, and I think they are fairly accessible, hence it's called public. The venture investment is more so in the private investment category, which is where, yes, it takes time, effort to either find or access deals, or you've got to do something to ensure that the deals come to you, right? Because in anything in life, either you're pushing to get to it or you're attracting them, right? So I think in private, there are again three buckets, right? One is direct angel investments, where you're investing in a young startup company, whether it's a product or service. You're directly investing in that company. It's no different than investing in a stock, just that stock market, let's say HDFC or Reliance or Apple, they are public listed, very large, hence relatively much safer. A lot many more people are trading. So it's relatively liquid. You can buy, sell. In private, fundamentally, it's not liquid. Once you invest, it's very high risk. It could take a long time before you get your money back. But if you get your money back, there is a decent probability that you will make a lot more return, not in percentages, but in multiples, right? So that's angel. Or you could do a VC investment where it's like a mutual fund. In a mutual fund, you put 100 rupees, the fund manager allocates the 100 rupees into maybe 30 stocks. In VC, you put 100 rupees, the VC manager or the general partner would probably allocate that into 20 startups within the venture capital, right? So it's no different than a mutual fund, but the underlying asset is early stage, growth stage startups. The third is late stage pre-IPO, which is basically you are investing into large, fairly successful companies with good traction. So, but before they go IPO, before they go public. So in India, for example, had people invested in Zomato, in LIC, in Nazara Games, in Nykaa pre-last year. So you would have invested pre-IPO, pre-going public. So if you look at this continuum, angel investing directly is probably the riskiest because you're putting individual bets in small early stage startups. Right. Venture capital is you're creating a basket of companies and you have a professional who's managing that. Pre-IPO is late stage, they've already grown, they're very large, they're maybe 1 or 2 years away from sort of going public. So that's the risk continuum. There's always a risk reward. So yeah, it's possible, but the question